So did you know there are 4 ways to make money owning rental properties? Actually, every investment, there are 4 possible ways to make money, but not all investments can make money 4 different ways. Most investments such as stocks, bonds, gold will have usually 1 or 2 ways of making a rate of return. Owning rental properties, however, has 4 different ways to make money and increase your rate of return. So today we'll look at the 4 ways, and I'll also take you through an example and show you how to calculate the rate of return for each area over the next 10 years as well as year 1. I will say that the key to becoming wealthy owning real estate is probably owning property for 10 years or more. You'll actually look like a genius the longer you own the property. So I'm Harold Powell. I'm a local real estate agent serving Ventura and the surrounding communities. And if you want to stay up to date on real estate for Ventura and the surrounding areas, well, I suggest hitting the subscribe and bell icon to be notified of future content. Now, one of the goals of every investor is to earn a higher rate of return. Now, one of the downsides of higher rates of return can be higher levels of risk. So, one of the challenges for every investor is to systematically reduce your risk while increasing your rate of return. Fortunately, rental real estate does just that, and I will show you how that's possible. Now, if you're interested, I am providing a link in the description below to access the Google Sheet calculation so you can calculate the 4 ways you can make money owning rental property for yourself. And in the meantime, if you already own rental property, you may be interested in watching my video on 1031 exchange explained and the strategy, since that is another way to magnify or increase your rate of return on your rental real estate investments while deferring taxes. Now, as I mentioned earlier, in every investment, there are, again, 4 possible ways to make money. So let's address the 4 ways to make money owning rental properties. Number 1 is appreciation. It's the first and most common way to make money is through appreciation, and it's the one people are probably the most familiar with. So when defining appreciation, we can summarize it to the desire of having the thing we bought today will be worth more tomorrow. Now, the qualification is that the asset must be sold to see the desired return. Now, the majority of the investments made out there are solely focused on this particular pillar, which we assume that every asset should have a trajectory of upward appreciation. And the challenge is that it offers very little control. There's often no guarantee when or if an asset will appreciate. So the question is, how long will it take to get that desired return? And in real estate, the property will go up with inflation. So number 2 is cash flow. This is probably the most important ways to make money from rental properties of the 4, though we must probably clarify the circumstances of cash flow, how they're beneficial. The key to cash flow is it must cash flow in order to allow you to retain ownership of the asset. So when using leverage, cash flow initially is not transacting to put money in your bank account, but actually to build up reserves in order to take advantage of appreciation. So once you have built up reserves, then you can enjoy the benefits of cash flow. Number 3 is taxes. One of the things to be aware of is a dollar pre-tax is very different from a dollar after tax. And the single greatest destroyer of wealth is the rate by which you have to pay taxes. The key to rental real estate is that it reduces your tax liability. Now, this is different from a tax deferment like a 401k, which your taxes are deferred to a later date. And when comparing different types of investments, most investors don't consider the tax advantage that adds to your rate of return. Now, when comparing 2 investments, one produces a return that taxes have to be paid on and the other does not, then they're really not equal investments. So with a rental property, you do get tax benefits while allowing the cash flow to come to you. Number 4 is leverage. Now, leverage is probably the most powerful way to increase your rate of return. what's important to understand is that leverage by itself doesn't produce a return. It only amplifies the return you're getting from the three different ways. Leverage shows up in the form of bank financing, and we're able to use a smaller amount of money, typically 20 to 25% of the value of the property, and then the rest is financed by the bank. This asset generates enough cash flow to pay the leverage or the loan and still have money left over. And another benefit of using bank leverage is the ability to amortize the loan over 30 years. So each month, there is a principal reduction of the loan balance, which adds to your rate of return. One other fun fact that probably put a smile on your face is the value of that dollar decreases over time with inflation. So each year that you pay the loan back, you are actually paying the bank back with money that is worth less than when you started. So you could say you're paying the bank back with worthless money. So let's take a look at an example so you can see this actually at work. Now, as I mentioned earlier, the Google Sheet that we will look at is available in the link below if you're interested in trying it out for yourself. Okay. So let's start with using this example of a fourplex with a sale price of $1.1 million. We're going to use a 25% down payment, a 7.3% interest rate, amortized over 30 years. And again, this is a fourplex, so we have 4 units, each generating $2,500 a month for a gross income of $10,000 a month. I've added the known expenses, which are taxes, insurance, 7% property management fee, a monthly water sewer cost of $400 a month. The other estimated expenses below are 5% for vacancy, which are down here, and 5% for maintenance allowance as well. So what this does now, when we go back up top, it's going to compute the monthly cash flow. There are 3 different types. There's the maximum, which is when everything is going swimmingly well. There's no other expenses other than the known expenses and the income. So it puts you just under just over $1,800 a month, and 7.6 cash on cash rate of return. The next one up is going to take into account vacancy and monthly maintenance expense. That we have those two, the 5% and 5%. It's going to take that off that. And then the last one, the monthly cash flow LT adjusted, that is for long term. And that's actually the one we're going to look at when we go to the next phase. Long term, for long term repairs, which need to be taken into consideration. So let's then, now that we have that number, we go over to doing our projections. So let's take a look at, and you can also take a look at the 4 ways things are going to be affected now. When we take a look at appreciation, we're going to assume appreciation rate is going to be 3%. The rent increases, we're going to assume, are 3% a year. We don't need to worry about inflation for this exercise, but your marginal tax rate we'll use is 30%. So once we have those numbers, now we can scroll down to the 4-pillar return and look at year 1. Year 1, you can see cash flow is now just over $6,000 a year. Principal reduction just under 8, tax savings just under 2,000, and appreciation just over 33,000. So again, this is how you're winning 4 ways. When you add each of the different ways you can win in real estate, your cumulative rate of return is just over 17%, or over $49,000 a year. And so that's how powerful this is. Now, what's interesting to see is when we flip over, these are each year, each of these numbers increases every year. So that by the time we get now to year 10, we are now, cash flow is considerably higher. We're at just under 30,000. And then we've got the principal reduction down at 15,000, and tax savings at just under 9,000, and appreciation just over 43,000. So that gives us now a rate of return of 33.5 and a cumulative a yearly return of income of 97,000 when you look at, again, combining all four, what that looks like in this example. Now, as I said earlier, one of the challenges for every investor is to systematically reduce your risk while increasing your rate of return. Now, you can see in this example that over time, owning rental property increases the rate of return in 4 different ways while reducing the level of risk by even paying down the principal loan balance down further each month. So the key to being successful in owning rental property is playing the long game of at least 5 years or more. And if you own it for 10 years or more, you'll look like a genius. Now, if you found this video helpful, give this video a like. Thanks.